Hi everyone, welcome back to my YouTube channel. Today I'm going to continue about the book that we were talking about in the last video, The Psychology of Money by Morgan Housel. The first point I would like to talk about is to be reasonable and not rational. Usually what happens in the stock market is that when a new bull run is beginning, most people get lured into the stock market and want to pile their money into the equity category of asset class. And this is the period when people generally ditch their fixed deposits, their retirement accounts, their debt mutual funds, their digital gold, and they start piling into the stock market to make more money. But what they don't realize is that this kind of volatility they will not be able to handle when the market overturns and corrects in the shorter period of time. When the market falls 5%, 10%, 15%, that volatility in their total portfolio has a direct impact on their work life, on their professional life, on their personal life, and on their mind. And this is when, at the worst time, they ditch their equity stocks and move back to the fixed deposits, move back to the safe returns that they used to get in debt mutual funds or in gold. And this is absolutely the worst time when they have lost money on many stocks and when stocks are actually undervalued and when they sell them at the wrong time. So we should learn how to be reasonable. Reasonability means we should have only that much money in the stock market that we can see fluctuating by 20 to 30% periodically. And we should not be afraid or we should not get panicked like most people get when the market goes up very high or the market falls very fast. We need to learn how to stay calm and composed even in moments of sheer terror. Volatility is the price that an investor has to pay for huge growth opportunities and for huge returns in the long run in a period of 5 to 10 to 15 years. Sequoia Mutual Fund or an investment venture capitalist fund, the head of Sequoia Mutual Fund was once asked, "What is the secret of your success over the last 40 years as one of the longest successful venture capitalist funds?" And the CEO said only two words: fear and paranoia of running out of business. So, a value investor needs to understand that he cannot be too much optimistic and he cannot be extremely pessimistic. He has to have a balance where, where he knows that the future is extremely bright, but it's going to have many pit holes. The journey is going to be full of pit holes that we have to face. And we need to learn to be fearful and rationally optimistic in the stock market and about the overall economy and overall structure of our governments and of our companies. We generally look at what the big investors have accomplished in the last 10, 20, 30, 40 years. For example, if I look at the track record of Mr. Warren Buffett, the greatest investor in the world, and I look at what he did in his life from the age of 20 to the age of 70, 80, 90, generally that makes you anxious as to how can I achieve something like this, or will I be able to get a return like he did in my investment journey. Well, instead of focusing on what these people did, we can focus on what these people did not do, and that is enough for us to reach not exactly their level but almost exactly to what they did in their lifetime. Like Warren Buffett did not panic in the 14 recessions that America had. Warren Buffett did not take too much debt. The only debt he had was the insurance subsidiary Geico in his company Berkshire Hathaway had an insurance float, which is a kind of debt on the balance sheet. That's the only debt they had. Warren Buffett never indulged in trading or in options and futures and was consistently using his skill, which is investing, and used time as an added advantage. If you follow this, this is almost equal to achieving his philosophy of investing. If one is very, if one is, if one likes the investor Mr. Vijay Kedia, he follows the principle of smile in the stock market. So he says that you should buy companies that are small in size, medium in experience, large in aspiration, and have extra large market potential. That means they are big fish in a they're a small fish in a big sea, and they're ready to take off and grow because they have experience and aspiration. They have fire in their belly to grow from a small fish to a big shark in that ocean, which is the ocean signifies a huge market potential, that the market is huge and they are ready to take over it. In the end, I would like to tell you all that we do not need a lot of stocks to make money, to make a lot of wealth in the stock market. Warren Buffett says if you pick 5 good stocks throughout your investing career, that is enough to make a lot of wealth for you. In fact, if you look at Peter Lynch, who was managing the biggest hedge funds in the 1980s and had a uh, total total asset value of that mutual fund, the Magellan Mutual Fund, was around $14 billion and the biggest fund in the USA in 1980s. He said that if you are the best investor in the world, you will only be right 6 out of 10 times. So if you're right 6 out of 10 times, and you just double or triple your money in 5 to 6 companies, and the rest 4 you're absolutely wrong, you would still have a very good track record as compared to the index, as a value investor, as a fundamental investor in the long term. That's all for today. Thanks for listening to me. Please subscribe to my YouTube channel, and for more videos, keep following me. Thank you.